Hello everyone, I am Vikas Pradhan and I will be discussing the outcome of the project evaluation computed for the case scenario of introduction of a new product and the business valuation and financial decisions in the following slide. So the first topic of the day is going to be if the project is economically viable. This is the data extracted from the Excel calculation of the business case analysis to study if the new project is economically viable. According to the criteria, it has to fulfill the following. The NPV should be greater than 0, IRR should be greater than WACC, and PI should be greater than 1. Now let's check the following data that has been extracted from Excel. As we can see, the NPV value is greater than 0 with a positive return. Moving on to IRR, the value is 37%, which is greater than that of 9.5% of WACC. Coming on to PI, that needs to be greater than 1, and that is achieved with a 1.54. So as you can see, it has fulfilled all the criteria that was mentioned above, and it shows that the new business venture is viable and profitable. Now moving on to the sensitivity analysis 1. If we alter the operating cost from 30% down to 25%, then we can see that there is an increase in NPV and IRR, and the payback period has been reduced to 3.24 years. Now for the sensitivity analysis 2, if the WACC is reduced to 7.75 from originally 9.5%, then the NPC increases steadily, keeping the IRR constant and yet cutting down the payback period to 3.21 years. Now, if the tax rate is increased from 27.5% to 30%, we can observe that the NPC decreases and the payback period increases to 3.58 years. Moving on to the next, let's talk about value of a company. In finance, the value of a company, often referred to as its enterprise value or equity value, represents the economic worth of a business equity. This value can be assessed from various perspectives depending on the context and the purpose of the valuation. Next, let's talk about the approaches to valuing a company. There are different approaches: market capitalization, time revenue method, earnings multiplier, discounted cash flow, book value, and liquidation value. Now let's move on to the next. We'll talk about the differences in aspect of private sector and public sector. They are different in all sorts of measures. Let's go with the ownership structure. The ownership structure is owned by individuals, whereas the other is with government or government agencies. The access to capital is limited in private sector, and for the public sector, it's through IPOs and debt offerings. Market transparency is less in private compared to the public sector. Coming on to the valuation matrix, it's based on private transactions, whereas for the public sector, it's on market capitalization. Growth potential, but there is a rapid growth for the private compared to the public sector. Liquidity, limited liquidity and shares and are not treated publicly. Higher liquidity as shares are traded on stock exchanges for the public sector. Moving on to the risk profile. The risk profile varies widely depending on the industry, and it's generally perceived for public sector. Exit strategy. Exit options include selling the strategic values, IPO and all. But for the public sector, exit options may be limited. Now moving on to the dividend irrelevance policy by Modigliani and Miller. The key assumptions. As Modigliani and Miller are perfect capital markets, rational investors, no agency cost, and it has several implications as dividend policy does not affect the firm's cost of capital. Shareholders are indifferent. Let's go in depth with that. The key assumptions underlying the theorem are it has a perfect capital market, meaning that the market has no taxes, no transaction costs, or no information asymmetry. The second one is rational investors. Investors are rational and aim to maximize their wealth. So every other investor who are investing in the business are looking for profits, and there are no agency costs. So this means that there is no interest between managers and shareholders. It is holistically for the profits. Um, the next is financing decisions are independent of investment decisions. A firm's investment decisions are not influenced by the financing, or it is individually independent for both. Now let's go to the theorem, implications of theorem. The dividend policy does not affect a firm's cost of capital or its value. Shareholders are indifferent between receiving dividends and capital gains. Firms should focus on making optimal investment decisions and should not worry about their dividend policy. Now, moving on to one of the debates, the most recent debates about the abolishment of double taxation policy in Australia. Australia had a system of double taxation where corporate profits were taxed at the company level, and then again when those profits were distributed as dividends to shareholders. The Australian government introduced the dividend imputation system in 1987 to address this issue, allowed shareholders to claim franking credits for corporate tax paid on dividends. So previously, double taxation system hindered investment and growth as it reduced tax returns for shareholders. Now, with the introduction of the abolition of double taxation policy in Australia, this allowed shareholders to claim franking credits for corporate tax paid on dividends. This eliminated double taxation, ensuring fairness and efficiency. Moving on to the next debate, it's about dividend imputation debate. The recently published article by Financial Review titled "Franklin System Will Just Create Bigger Problems" discusses the proposed challenges to the Franklin system by the Australian Treasury, which aims to address the issue of companies raising capital through fully underwritten capital raisings and then promptly paying out all the money raised as franked debit. The aim of the debate is that it addresses companies raising capital through underwritten capital raisings and payment out as franked dividends. The reason is that it is a disadvantage for small business and it's a huge challenge for new companies and has a risk to shareholders. The impact of this debate could reduce corporate tax payments. Moving on to the next slide, it's about superannuation taxation debate. As we all know, this has been an ongoing process and it's still ongoing at the moment. So with the recent debate posted by Hannah Wotton, according to the recent article, Super Tax Changes to Cut Off Lifeblood of Local Business by Hannah Wotton, the Australian government's proposal on tax unrealized gains in superannuation accounts with balances over 3 million has sparked a heated debate. The proposal has sparked a debate over the potential impact on investment and retirement savings. The highlight of the debate are as follows. It illustrates the delicate balance between encouraging retirement savings and ensuring superannuation system sustainability. The government aims to address the fairness concern but raises concern about the impact on investment and economic growth. To conclude this, the government faces the challenge of addressing fairness issues while considering potential economic impact. This is the end of my slide, and thank you for listening.